Good morning, everybody. Mike Vacchi, PrincetonTrader.com here for NTMarkets.com with your Friday morning pre-market webcast. Okay, it's non-farm payroll day. We got the jobs report coming out at 8:30. It is about 5 after 7 here on the East Coast. Getting this out a little early because I've got to do my subscriber webcast after the number comes out. But you know, the way I trade jobs and what we talk about every month is you certainly don't, as an individual trader, want to anticipate what this is going to do. What you want to do is you want to wait for the reaction. And once that reaction comes, it's going to define a range. It either breaks up or it breaks down, then it kind of comes back, and it creates a high and a low. Watch those highs and lows. Watch and see if they get retested and they fail. Or if you get a breakout above or below that initial range, and on a move back to test the outside of that range, the range holds. That usually sends us higher on a breakout or lower on a breakdown. So that's just 30 seconds on the safest way for you to trade jobs. It's certainly not to sit down and try to play Russian roulette with what the reaction on the number is going to be. Think of what would have happened last month. 88,000 jobs. And we had an initial down, but we ripped. Because the feeling was that kind of a lousy job number is going to keep the Fed in the game. Who knows what's going to happen now? Say we get 150, 160, 170,000 jobs. We going higher because it's a good number and the economy's good? Or are we going down because the Fed may take their foot off the gas? Don't get involved in any of that. Let the number come, watch the reaction, gauge the range, and trade accordingly. Okay. So yesterday, bulls had a good day yesterday. There's really no way around it. The reality of the last couple of days is, yesterday technically was an inside day, but any momentum that the bears gathered up on Wednesday, the wind really got taken out of their sails today. And I think a lot of that has to do with the fact that we've got the jobs number coming up, and what you've got here is just 2 days of people kind of squaring up and waiting to see what's going to happen. We're still sitting here around this 1590 level. Despite all of the bulls' move yesterday, they still could not take out those highs. So that's significant now. It will take literally nothing to take them out this morning with a catalyst like the jobs report. So a couple things. If we move higher today, if the jobs report gives a positive reaction that's sustainable, I would expect us to come through the upper band, the 1603 to 1606 area. At that point, we'll have to see what happens. Certainly if we extend into the third standard deviation band, that's certainly an area that you want to think about putting some shorts on. Okay? But I would not anticipatorily short a touch of the upper band. You can probably fade that, but as far as a swing trade or anything multi-day, I would wait until the upper end of the range becomes at least tested resistance. On the downside, we have got to get through Wednesday's low down at 76 and go to work on the 71 area, which is the middle Bollinger Band. The bears don't really get any points in my book until we close, not trade, but close below the middle band, which is 71, 72. At that point, we start to think about the lower band, about the 50-day exponential down at 1550, and the lower band down in the 1530 area. But the key for the bears is they need to push it down. They've got to get below, they've got to crack 88, and they have got to get back down through 83 and into that 76 area and defeat it. That's a lot to ask today. You're asking for a 20-handle move today. But with the jobs report, if it's a lousy reaction, today's your day. So we're in our pre-non-farm payroll wait and see. So we'll see what comes out. Everybody have a fantastic weekend. Mike Vacchi, PrincetonTrader.com for NTMarkets.com. I'll be back Monday morning with another webcast. Trade them well, everybody.